Good morning, traders. Today is May 29th, almost the end of May, the start of June. Markets have been very interesting lately. Nice little rebound last week. You remember I was talking about the markets looking for a bottom over the last couple of weeks because my volatility index was showing that the markets were not selling off aggressively internally, even though we did see some panic selling in the markets overall. Long and short of it, that bottom materialized this week. Caught a lot of people by surprise, I'm sure. And my warning to you this week, if you take anything away from this, is to be cautious. This rally phase may not last very long. It may be a kind of a dead cat bounce, just a little bounce in price after this extended selling. I'm telling everyone to stay cautious and stay protected. If you've been following me long enough, you know that we moved to cash well over 2.5 months ago. We got out of our position. We've been staying in cash. We were actually selling into this trend late last year, telling everyone to get out and start protecting profits and pulling to cash. We had moved to nearly 55% cash by the end of 2021. And now we're in the smaller portfolio. We're 85% cash. We're 65% cash in our current. We still have a 10% stock allocation because our longer term systems are still bullish. So understand, and I'll show you these charts. Longer term, this is just a correction. This is nothing more than a price correction right now. Shorter term, everything is turned to bearish, which is why we're holding a very small stocks position and properly positioned for hedging with bonds and metals. Longer term, we are still bullish. Shorter term, we're neutral bearish. And like I said, we're just going to continue to ride this thing out. Now, what I want to try to do is show you back over here what we're seeing with regards to the S&P. This is the weekly S&P chart, S&P E-mini futures. You can see we had this very strong rebound last week. Very, very strong after hitting the 382 Fibonacci level. I'm going to warn you that this could still very well be an A, B, C, D, E move targeting somewhere around this 0.50 level. Now, this is going to be interesting. I'll just leave it there and move it. Oop. Oh, heck, I'll just start over if I can. My mouse seems to be giving me trouble, but I'll just try it again. So let me just try right here and do this. So ideally, a downside wave would be closer to this area in the S&P. It would be almost equal distance between these levels. So hypothetically, if I were to draw one from here to here and then clone it, and duplicate it from where I think it's going to be, it puts us right down to this 3490 level on the S&P. And that's where I really think the bottom in this move is going to happen. This will freak out a lot of traders. This will cause a lot of people to end up getting short. But in the longer term side of things, I need you to understand that this still consolidates at a level that is above this previous peak, which is important. It still qualifies as a proper Fibonacci structure, an Elliott wave structure. Even if it were to get down into this area, it would still qualify. But the long and short of it, ladies and gentlemen, I think this 50% level is next. I think it's just going to take the Fed or some other crisis event to get us there. And in the meantime, we've got to consider this move to be, call it short-lived. Call it it's an impulse bounce. And I think we're really going to see some weakness somewhere up in this 42.13 area, which indicates that we're very, very close to potentially another top in this pattern. Okay? And then you can see it's almost the exact same pattern here. In fact, if I were to draw this from this low up to here, about where it ended, and then duplicate it, and come down from this low to this high. Yeah, so that puts us at 42.82. I'm thinking more around the 4,200 area, 42.20. That's really where I think this is going to end. Okay, so now let's go ahead and take a look at some of my primary indicators, and let's spend some time first with right here, the FANGs index. FANGs index has come all the way back down, quite aggressive selling, back into the middle green channel of the standard deviation. We've gotten quite low down here. You can see this lower channel was breached during the COVID crisis, and then during the 2018 crisis. This was when the Fed was raising rates and tried to, this was an unwinding phase as well, which was quite interesting in the sense that we saw this pull back quite a bit. And maybe I'll take a look at this on the weekly chart. But now the selling that we've had recently has been very aggressive, from 1,300 down to call it 800. That's about a 33% roughly collapse in the FANGs index. If the unwinding phase continues, then we're looking at a move back down into this 720 area. Could even get deeper, could get way down here if the unwinding phase is exceptional, and that would put us back to 2019 levels. You can see the FANGs index has really accelerated after COVID. If we were to unwind all of this and move back down into a more middle channel here, that could put us right down into this 670, 650 level fairly easily on an unwinding of technology. And that could happen. The Fed raises rates, technology likely to collapse a bit further. They're typically fairly debt heavy. And you may see consumers unwind out of technology on a very quick basis. Now, the U.S. stock market index is bouncing off this 382 support level. Had a good strong bounce last week, but remember, we still have that A, B, C, D potential up here in the, let's call it 1150 area, 1160 area, and then possibly an E move back down into this area, which is highlighted in this green rectangle. And this rectangle is the range between the current lows and the pre-COVID highs. I think this is really going to end up being our critical support level over the next 2 or 3 months as the markets try to hammer out a bottom. So we've seen this sell-off. We've seen this little exhaustion wave here. We've seen a sideways move. We got a little bit of a rebound here. I think this is going to end probably in a week or two, and we're going to be back down in these levels trying to move somewhere near support. This could continue to unwind even further, but right now I'm thinking this is going to be our primary support level, at which time we could see a fairly substantial bounce. Lasting many weeks, possibly months, and moving possibly 11 to 15% higher. This is a very iffy, sketchy kind of a bounce move. It's kind of like, when you look at these moves downward, you'll see here, boom, you get a couple moves higher, then boom, comes up, and this rotates back lower. We didn't see it in COVID, but you can see we get these kind of bounces where it'll move higher, move lower, and then just collapse. We had a number of them back over here. Move lowers, freaks people out, and then turns around and rallies. This is the same type of scenario, but in the inverse. We get this stronger selling, we get a bounce up, collapses. We get a bounce up for 2 weeks, then collapses. We get a bounce up for off of these lows way down here, comes all the way up. Everybody thinks it's time to buy, and then it collapses for 2 more weeks. So this is very, very iffy right now. I wouldn't recommend trying to get overly long or betting the farm on anything. Run very tiny positions and prepare for what could be a very volatile few weeks over the next couple of weeks. The Smart Cash Index, which is more of a global measure of market trending, is showing a second week of upward activity. We're still within this channel. Understand that we could trade in this channel just like we saw here in 2019 for the next 12 or 15 months. So we're still in a downtrend, very solid downtrend. If this fails and breaks lower, we could end up back down in this 135, 130 level. But also, we could end up trading sideways here. If the global markets start to find some support, we could trade within this range for a number of weeks or months going forward, like we saw back over here. This type of a rally, like we saw in 2017 or post-COVID here, 2020, this takes some real exceptional buying momentum. And I don't see that coming into the markets this year, maybe next year, but I don't see that happening in the markets through the rest of this year. Next, we have the metals index moving quite nicely off of these lows. Remember, I'm calling this the yellow brick road. This is a channel. It goes all the way back to 2018. You can see it's basically gold has stayed within this channel, got up above it here during the post-COVID crisis, came back down, reestablished support, bounced off this level recently off this extreme selling. Now I think we're off to the races. Granted, it's going to take many weeks and months to get there, but I think we're off to the races to the upside. So metals should start to grind higher, and I expect it to really be back, gold to be back up above 1960, 1970 within a few weeks. Silver possibly up into the 23, 24, 25 level much faster if it starts to really take off. But all we need is a little momentum out of this back up into this, call it 450 area, and that'll put gold closer to 2000, and everybody will start paying attention to it again. But again, this support level off the yellow channel and these horizontal blue lines become key support for metals. Metals should take off nicely in the next 2 or 3 months. Just this is the bottom we've all been waiting for. To pay attention, it's here. The valuations index had a nice little rebound last week. I still expect it to move a bit lower. Again, as I mentioned to you, the next 8 to 12 months probably continued unwinding, particularly if the Fed raises rates again. But understand that this is just a little rebound. You can see how we had a little rebound right here, and then it rolled back over almost immediately. You can see we've had a couple of these rebounds. There's one here, then it rolled over, then a strong one here, then it rolled over. They happen. You get these little rebounds, and it rolls over and goes sideways or downward again. I think that the valuations index must come back down below the 60 level to really find some support. It's almost like a reset. So understand that we're still in an unwinding phase. It's just going to be a matter of time. Commodity to gold index has moved back down to 2.2 again. This is relatively low. But remember the rebound we saw in the FANGs index and the U.S. stock market index and others compared to this? Look at this move here we saw in the commodity to gold index. It's not really showing us that there's any real growth or strength yet in this rebound, this little bounce upward, which again provides me a little bit of an indication that we should be very, very cautious near these lows. The rally is not going to be here that quickly. It may look like a nice little rally. It shows plus 22.54% last week, but understand that this is a very moderate move. It could just as easily roll back to the downside, move back to 1.9, 1.98, end up trending lower off of a continued unwinding phase. So stay very cautious. The volatility index, which is one of my favorites, again, had a nice solid upward move. You can see I've highlighted the bottom here. I've been warning for many, many weeks that this doesn't look like it's going to really continue much lower. It looks like it's just setting up a bottom. We did have some unwinding in price, obviously, in the Nasdaq and global markets and the S&P, but this is telling us that there's a fairly solid support level taking place. And in reality, ladies and gentlemen, this downward channel is likely to continue to play into what we're doing. So a move up above 10 or 10.5 back into this area may stall back out, may roll back over the next, say, 2 weeks or 3 weeks and turn into a very aggressive downside move. So be cautious. We don't have a lot of upside move here, in my opinion. We only have maybe another 4, 4.5, 5%, maybe. Okay, I think that's it for here. Yep, this is an old TT scanner. So let's come over and take a look at the TT scanner. TT scanner right now on a weekly basis has got these existing longs in XOP, IXC, XLU, and XLE. All energy except for the utility sector here, the XLU. We got a flat signal here in IBB. We have a new short in biotech. We have a new short here in consumer discretionary. We have a new flat here in IGV, software sector. And we have a new flat here in XT, the Exponential Technology ETF. Otherwise, we have variant types of signals. These are mostly carryover. None of our long-term signals are here any longer. They've all gotten out of trades. We have a few here that are 15, 16 weeks long. These new shorts are only a few weeks long. Some of them have already hit targets. This one has, and this one has. These have already hit targets. This one's up 7%, working on its second target. But we're getting kind of a mixed signal here. Energy is still looking like it's going higher, although it's hit all our targets. And we have the new signals here in biotech and consumer discretionary. Consumers are pulling away from the economy. I'll get to that here in a minute. Now, let's move. In fact, let's go to the consumer side. And this is the Consumer Engagement Index, my new custom Consumer Engagement Index. And we did have a bit of a pullback. This is a monthly chart. We did have a pullback last week, obviously, with it off of this low. We had it move down to the 50% low or 50% Fibonacci level, and we did see it come back out of this. But you can see we're at new lows here. It'd be very interesting to see if this can move higher before the end of May, back above this green line or this 382 Fibonacci level. I don't think it's going to make it. So we're really kind of in this range bound here, looking for some support. And more than likely, as I mentioned to you, we're going to have kind of an A, B, C, D, E type move back down to this lower level before we really find some support. Consumers are being beaten up. High gas prices, high food prices, high borrowing costs. They're really being beaten up. And their natural reaction is to go into what I call a protectionary mode, which means they spend only what they can afford to spend on the essentials. They don't buy too much of anything else. The custom technology ratio last week collapsed even further. And this is weekly, although it looks like it is a monthly chart. It's labeled weekly, but it is monthly. I'm trying to show you a bigger picture here. But at this point, ladies and gentlemen, we've wiped out the 2015-16 level. We've wiped out the 2017 rally. We've wiped out the COVID rally, which took place back over here. And what we're looking at right now, ladies and gentlemen, is as far as the technology ratio goes, technology is down to 2013 levels in these lows, right in this area, and is likely going to unwind even further, possibly back down here, the 2011-12 levels. Now, this doesn't mean that the price levels have unwound to this type of level. It means the ratio of how technology is factored compared to the SPY. Technology has really wiped out a broad scope of growth going back, from 2013 until now. That's almost 9 years. It's wiped out almost 9 years of actual growth in this ratio, which means we're going to be looking for a bottom at some point over the next 5, 6, 7, 10 months. But right now, technology is very, very dangerous as it unwinds. It could stay in this sideways mode for quite some time once we find a bottom. The U.S. to stock market global comparison. This is as of May 21st. This is an older one. I'll have to find a newer one. Okay, so let me come back over here. And let's go to, this is the newest one, May 29th, today. So here we go. You can see the global index has started to bottom off this level that I predicted many weeks ago. We'll see how this holds up. This actually goes back to the 2014-15 levels. So understand that this is trying to find support, could very easily end up in this blue rectangle support range. I don't believe it's going to be down here near these COVID lows, at least not yet. We don't have any impetus to see this kind of a scenario decline. This was an election cycle here in the U.S. market. And then we came out of the election year, 2017, and we started to see this big rally. Then we had COVID wipe us back down to these election year lows in both the U.S. and the global markets right over here. I don't believe we're going to get to that point yet, but I do believe that the foreign markets, the red line, will find some support near 750 before the U.S. markets find support. And the U.S. markets may need to unwind a little bit further down into this 920, 940 area, which would create that A, B, C, D, E type pattern down into this area. So understand, we're still in an unwinding phase. The Fed is likely going to raise rates, and we still have some potential risk in the market. So don't become overly cautious or overly aggressive with your long trades right now. The custom global asset index, my new custom global asset index, has shown that from 2007, 8, 9, this was the appreciation of the housing market before the markets actually collapsed. This was the collapse that took place during the 2008, 2009 cycle. It was a period of no growth, a lot of Fed activity to try to save the markets. Then, as you can see, we started to see some real growth come out of this. We went into this upward channel, stayed into this upward deviation channel for quite a bit of time until the Fed ended the first phase of their stimulus package, 2013. Then we went into another growth phase until it ended again in 2015-16, which was right before the election. Then we went into the 2017-18 growth phase, which was the Fed attempting to tighten. We had a continued growth phase. Then by the end of 2018, which is right here, we went into a sideways downward channel. You could see we kind of adjusted from this upward channel to this lower channel. Then we ended up in the post-COVID. This was COVID right here. And we rallied right back up into the middle channel, stalled, double top, and now we're at the lowest level we've seen in 20 years. Okay, literally in 20 years, we have not seen this global asset valuation move to this level into this standard deviation channel. And my fear here, ladies and gentlemen, is that this is a broad unwinding of capital, and it could continue to just meander downward, 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 eventually maybe trying to find support around these 2015-16 levels. Now, I've mentioned this many, many times, but 2015-16 really is a baseline. This was an area where the Fed had kind of prompted the market. Globally, the market had recovered to just above the 2008 and 9 highs. So the U.S. stock market and everything had kind of gotten off of life support and moved into its own growth cycle. 2017 was the first real phase of that. But what's happening right now is we've got this unwinding of asset bubbles. And again, I've used the term beanie babies. I'm going to say it again, but when things break and they change fairly quickly, you can have an unwinding of asset prices continue for many, many months, possibly 2 or 3 years, until some safety normalized value is going to occur. And this is a big move, okay? This would reflect from 0.6 to 0.1, roughly 1.2. That would reflect about a 40 to 45% downside move from these upper areas. Now, this is inverted, so you have to do the math backwards. But understand that assets that have been overpriced may unwind 30 to 40%, and that does include your house and other assets. Gold, of course, might do the opposite, because as this unwinding phase takes place, gold and silver should take off like mad, especially if there's severe fear. But yes, home prices are likely to probably unwind at least 30 to 35% over the next year. We'll get to that here in a minute. This is the gold in depreciationary cycle phases. I've talked about this a bit before. This was the end of the gold standard. We had a huge 450% rally in gold. This was the Reagan-Clinton era, 88 through 96. We did have the technology bubble take place. We had quite a bit of federal government spending. Gold was very much out of favor at this point. There was just nothing really sparked a lot of fear. The fall of Russia, you had Reaganomics, you had Clinton coming into play. There was no real massive fear factor here. This was a creation of credit when the gold standard ended. This was a creation of credit with no real fear. This was a creation of credit after the 9/11 attacks. And then we started to see gold really start to ramp up and really start to rally after the 2008 and 9 housing crisis, which is right here, the global financial crisis. Then it peaked out, stalled, found a bottom in 2015, really started to move, and then we had COVID. Right here, COVID sent gold skyrocketing higher. So COVID became the global crisis event, much like the housing market crisis event here, or what you could turn around and say would be the dot-com bubble event back over here. And now we're looking at a massive inflationary phase. We've seen more credit creation, Federal Reserve creation of money in the last 4 years than we've seen probably in the last 15 years solid. And I believe that this expansion of credit from really the 2008 cycle phase here creates, it's hard for me to draw on this, but creates a very big bubble. In reality, if I could almost draw this as one big bubble of credit creation, I believe that this is wave one, this is wave two, wave three will be almost exactly the same, and we could be wave four and then wave five even higher. So be prepared. Gold is on its way up to 3,600 in my opinion, or much higher. Next, we have the Bradley Custom Gold Cycle Index chart. This is a new cycle index, and what I want to point out are these bases and bottoms that occurred here. So this is the 2013 to 15 base after the 2011 peak. This is the 2011 peak that came in here and unwound. This is the 2013 to 15 base. This is the 2018 to 19 base, which just happened. And then here we have the new base over here in 2020 that's just happening. And what I believe is going to happen here, and you can see this is gold, the line here, the gold line. You can see these basing levels enter a period when gold is unwanted. Gold is unfavored. So at this particular level, gold was favored in the 2011 cycle, but this is near the end of the cycle. It's really starting to sell off, become unfavored. And that's what shows here. It was unfavored for a while, then became superheated through the end of this move, then rolled over at this point, become unfavored, then became superheated again, then became unfavored. Okay, as it reached this peak up here, it became unfavored, and then it became unfavored, and then it became superheated again, and now it's out of favor, and it's reaching a base here, and now it's likely going to become superheated again, and that could prompt gold up to, again, 3,200 to 3,600 on a very solid upside move. Okay, next, we are done with that one. Let me go back. And let's go to the real estate market. Highest price reduction count in recent history. People are dumping real estate at whatever they can get it for right now, because a lot of people are sitting cash rich in their homes, and they know that the Fed has got to make moves to try to stomp off inflation. So you're seeing huge price reduction numbers, huge inventory numbers. Still, we're seeing high price levels. This blue line here, we're seeing price reduced shares starting to climb. It's now at the highest level it's been since, 2017, really. This is the highest level on this chart. And we have days on market staying relatively flat. So understand that we've seen this move up. Days on market has gotten longer. Homes are selling slower, but we don't yet see this actually start to climb. When days on market shoots up, inventory moves up, and price levels come down, when this blue line comes down, this top blue line, that's going to be an indication that aggressive price reductions are taking place. Reductions are the highest level we've seen in history at this point, as far as I know. But that means that it's a moderate reductions. You got a lot of people out there knocking a couple $1,000s, or 4, 5, 10% off their house, trying to get some buyer to come in there and take advantage of it. But the reality is, ladies and gentlemen, this is a sign that sellers want out. They're basically, give me a decent price, get me out of this so I can ride it out for 10, 12, 20 months and buy into something. Even if I take my capital gains tax and or do something else with it, the reality is they want out. They're trying to sell their beanie babies before the bottom falls out of the market. And that's what this is telling you. Another Fed rate increase will probably send this skyrocketing, send houses down lower, and send inventory even higher. Everybody wants out. Okay, I think we've covered everything over here. Yep. Okay, so let's get into the charts. We've covered this. Let's go over the TradeTank.com charts. These are my rotational modeling system. You can see the S&P is bullish weekly, bearish daily. We're still looking for this to form some support and move sideways. All of these charts are going to look fairly similar until we get to gold and crude oil and others. The Nasdaq is bullish weekly, bearish daily. The Dow Jones is bullish weekly, bearish daily. Takes a little while to load these. It's pulling up quite a bit of data. The Transportation Index is bullish weekly, still pink here, but bullish, and bearish daily. Looking like we've got a nice little bottom here. We'll see what happens. The financial sector is bullish weekly, bearish daily. Now, financials could see a pretty solid rally here, FYI. They've rotated down off of this channel again. Fairly good signal here if it starts to form some support. Still be cautious. Don't jump into this thinking that the markets are going to go straight up. The SPY came down off my support channel that I indicated and is bullish weekly, bearish daily. Nice solid rally here. Remember, we're looking for another down leg, possible down leg or sideways congestion. So be prepared. Gold is up $3 as of Friday. Bullish weekly, bearish daily. We're really looking for this to form some support and move back up to this 2,000 level or higher. Silver up 17 cents on Friday to 22.13 and a half, forming very solid support in this area. Still bullish, even though it's pink, it's still bullish up here with these yellow dashed lines. Bearish daily, looking for it to get back up above 25.26. I think it'll be a very quick move, maybe over the next 4 or 5 weeks, but we shall see. Crude oil is $115. Seems like the never-ending move. You can see it is still bullish in yellow, bullish weekly, bullish daily. We're nearing this resistance level again, depending on what consumers do. And again, consumers are a big driver of demand and what they're going to do in summer. I really think that the Fed and underlying conditions are going to start to erode the demand side for crude oil. Now, supply side may still be an issue, which keeps prices up above the $100 level, but I would not be surprised to see this move back down into the $84, $85, $87 area on a surprise consumer demand reduction. Simply put, people just aren't going to be driving around at $6 gas, which is what it is out here in California. Natural gas has got above $9. What an incredible move. It just keeps climbing, climbing, climbing. And if you remember, way back over here, I was warning everyone that this would be a move of a century. I was just way early on it. But anyway, long and short of it, still moving higher. It's tough to argue with this until things settle in Russia and we know what's going on with supply. Be prepared that this could continue to move higher. It could continue to try to rebound and find some support. Please also be aware that daily, every couple of days, you're getting, 20, 30% moves in this market. So this could be a very dangerous market if you're on the wrong side of it. Might be wise to just pick up some options and deal with the cost factor, trading the options instead of trying to put yourself involved in UNG or the futures market. Okay, next let's come down to TLT. TLT is forming a base. We don't have any real buy triggers yet. We will see what happens here. Like I said, looking to try to move back into bonds here on a protectionary move. It's been very, very weak. And again, but I do believe that bonds will come to life probably in the next 20 or 30 days, maybe a little longer, and we will start to see a big rally out of this. Okay, so lastly, let's take a look at the marijuana market. I know that a lot of people are looking at that. And the marijuana sector is still trying to form out a base. We need to see some type of activity. The entire market's been really underperforming, but it's just tightening down here on very narrow trading activity. You can see here on the daily chart, if you really look at it, we blew past the $9 level, which I thought was going to be support, came back down here. Now we're kind of in a sideways channel here. This could be a very good opportunity if we see some kind of a spark in the marijuana industry, but really, and I hate to use that pun, but there really hasn't been any spark. So there's nothing that's driving the expectations in the marijuana industry with regard to blowout earnings or new technology or anything. It's just kind of waffling, waiting for some kind of a real hype to kick in again. Okay, I think that's pretty much it. We will come over here and take a look at some of these charts here. I'm going to go to the ES. This is the weekly chart. This is my other TT Charger model. TT Charger went bearish on the ES about 3 weeks ago. This is not the rotational modeling system. This is more of a shorter term type of a reactionary modeling system. So understand that we are bearish. We're in this rotational move. We need to see some support hold up here. Otherwise, we could continue into a downward trend. The Nasdaq moved bearish as well many weeks ago back here. And as you can see, we've been in this sideways downward trend. You can see how I've drawn these charts. It's almost uncanny how these charts played out. This is where I was expecting it to potentially come to, and this is where it went to. So now we may be finding a bottom and maybe moving higher, but we need confirmation of this move. The Dow Jones is bearish as well. You can see we've come down to almost these previous low levels. We really need to see some support hold up in this market. Let's check the SPY. SPY broke through my support channel. It's into my support zone. I highlighted this level as a potential support zone, which would align with my ABC correction. So understand that if we were to come from these highs, A, B, C, potential D, E, down into that area. So that's kind of what we're looking at as a potential move here going forward, ladies and gentlemen. Let's take a look at gold. Gold is still bullish. You can see here I'm zoomed out. These little dots indicate bullish trending. We've gone into bullish neutral breadth here with the blue line for the breadth, but we're still showing long-term weekly, or let's call it intermediate term weekly bullish trending. Silver is bearish trending right now. It flipped back 3 weeks ago into this sideways channel, got below our support channel here. We're right back above it. I believe this is a real solid washout low in silver. That's what I believe this is in metals. Crude oil is obviously still bullish. It's established a new support level last week right up here. And you can see we have this support channel going, or resistance channel going all the way back to this area back over here in 2011. That's why this area could really turn into a peak. We've had our little blow off already right here, this blow off peak up to 130. Now we're kind of resting near this resistance. And if this market fails, or if consumers pull away, we could see oil back down in the $92 to $86, $87 area very quickly, coming back down into these highs roughly. Okay, let's take a look at bonds, which I know will already be bearish. Already bearish in bonds, kind of stalling off of this deep selling. Let's go to, let's see what this is. I think this is real estate. Yep, real estate is flipped into bearish trending back in February, early February. We're starting to see some bearish market breadth right now. So understand that an unwinding of real estate, when you look at the IYR symbol, And I'm trying to get a gauge for where we're likely to go. We could be looking at somewhere possibly into this area. And that would be a 22% downside move in IYR, which would reflect about a 30-35% downside move in actual real estate. So be aware that we could see a big move to the downside in real estate. Okay, well, that's about it. The most important thing, again, ladies and gentlemen, is that we need to be aware that the volatility index could be contracting into a very narrow range. So it's not unlikely that we could be contracting into a flag formation here. And the way I would count that is 1, 2, 3, 4, 5 breaking down. And that could be the very next thing we're expecting 2 or 3 or 4 months out into the future. And then secondarily, the commodity to gold index is really not showing any real growth in upward trending, meaning that these little bounces we're seeing like this in the smart cash index, or this in the US stock market index, or this like we're seeing in the FANGs index, these little bounces right now may be kind of a false, like what they call a dead cat bounce. It's bouncing up because it's been overextended to the downside, and it may end very quickly. It may collapse very quickly, and we could see a broader market sell-off over the next 2 to 4 months. It really depends on what the Fed does and how much we're going to be unwinding. You want to pay attention to, where is it? I think it's here. You want to pay attention to this, the Bradley Custom Global Asset Index. This tells us that assets have not unwound. That's telling us that inflation is high. We don't have any revaluation of assets yet. Although the stock market has come down, reacting to the Fed, reacting to anticipation, the stock market leads the asset value. So understand that we're seeing the stock market bounce off of what may be an oversold move, but we don't have really any unwinding of assets yet. We haven't seen any real unwinding of assets since 2008, 2009, which lasted almost 3 years before we found the Fed moving us back into a kind of a rally phase with easy money policies and trying to support the global economy. Right now, we've seen this excess phase, and I'm thinking we're going to be moving into a new channel. If I could draw on this, which I can't right now, I would almost say that you would take this line and this line, come across here, which would put us right over in this area, and then duplicate that line off of these lows, and that would put us somewhere down in here, this 0.90. And I would say that's the next channel that we're looking to move into. Ultimately, we could come down into this area, which would be a very deep unwinding, 40-50% unwinding of asset prices. But in reality, we may see another 20-25% decrease in asset prices back into this 0.90, 0.92 area. And that may be where we try to find support, or the Fed finally calls it quits and says, hey, enough is enough. We need to support the economy. All right, sorry about the length. Very interesting market moves. Stay cautious and wait this thing out right now is the best advice I have for you.